Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Wednesday, June 14th at 2 p.m. in London. It's hard to ignore a sense of relief and increased optimism that's starting to percolate among investors. After a hard 2022, there was widespread trepidation entering this year that slower growth, quantitative tightening, and further rate hikes would continue to pressure markets. Yet year-to-date performance has been pretty good. Is that evidence that these problems aren't really problems anymore? Markets have been strong, but in terms of that strength showing that markets have passed the test of slower growth or policy tightening, I think it's more accurate to say that it's too soon to tell. Let's start with the idea that markets have already weathered a period of weaker growth. While leading economic indicators of the economy are soft, so far actual activity has held up pretty well. The U.S. economy grew 1.3% in the first quarter and has added 1.6 million new jobs year to date. It's the coming quarters, specifically the next 3 to 6 months, where our economists see the weakest stretch of economic activity. Next, how about market resilience suggesting that rate hikes don't matter, or at least don't matter very much? Here, we think the question is to what extent rate increases hit with a lag. The optimistic case is that markets are forward-looking and thus have already discounted the full impact of very large recent rate increases by both the Fed and the European Central Bank. But there's also a school of thought that higher rates don't fully hit the economy for 12 months or more. 12 months ago, the federal funds rate was still just 1%. Maybe the full effects of policy tightening haven't yet hit. Another part of the theme of tighter policy is the reduction of central bank balance sheets, or quantitative tightening. Again, it's tempting to view recent market strength as evidence that this dynamic doesn't matter as much as expected, and that may be true. But I think the jury is still out. Year to date, the aggregate bond holdings of the world's central banks have actually risen, not fallen, thanks to continued easing from the Bank of Japan and support for the U.S. banking sector from the Federal Reserve. That should now change going forward, with these balance sheets shrinking, giving us a better measure of the true impact. Third is the effect of tighter lending conditions. The optimistic case is that following quite a bit of banking sector volatility in March, recent market resiliency shows that this is just another test that the current market has passed. But lending, like monetary policy, could act with a lag. Morgan Stanley's banking analysts see tighter lending from the U.S. banking sector playing out over an extended period of time, rather than quickly and all at once. Markets have been resilient year to date, a welcome respite from a poor 2022. We don't think, however, that this resilience is yet proof that markets have successfully answered the question of what the impact of lower growth, tighter policy, or tighter bank credit will be. Rather, these questions are still sitting there, waiting to be answered over the next several months. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.